In a move to further punish Russia for its invasion of Ukraine, the United States is considering a ban on Russian oil imports without the participation of allies in Europe. Two people familiar with the matter told Reuters Monday. The White House is said to be negotiating with U.S. congressional leaders who are working on fast-tracking legislation, though White House Press Secretary Jen Psaki said there's no decision yet.
Well, no decision has been made at this point by the president about a ban on importing oil from Russia. And those discussions are ongoing internally and also with our counterparts and partners in Europe and around the world.
President Joe Biden Monday tried to press his case in a video conference call with the leaders of France, Germany, and the United Kingdom. But Germany, the biggest buyer of Russian crude oil, has so far rejected pressure for a ban. The United States, which has imposed a host of painful sanctions against the Russian economy, President Vladimir Putin, and many Russian billionaires since the invasion began, has stopped short of targeting Russia's oil and gas, worried it could drive energy prices even higher. Oil prices have soared to levels not seen since 2008, and Americans are getting sticker shock at the pump. But some don't mind if it means condemning Russia.
As far as I'm concerned, we should raise the gas price. Stop importing oil from Russia and put the hurt on them. It's going to make inflation go up even higher, but we got to do what we got to do.
Meanwhile, Axios reported that President Biden might make a trip to Saudi Arabia, as the United States seeks to get Riyadh to increase energy production. A White House official didn't deny the report, but said it was premature speculation and that nothing was planned yet.
Our industry, the oil industry in particular, as I have said elsewhere, is under siege. The world is facing a possible threat to supply from the Russian Federation, which is the second largest exporter of oil and liquids in this world, a partner in the declaration of cooperation that we entered into with the 10 non-OPEC countries in December of 2016. And the perception of consumers and the world, the market in particular, is that this threat, whether it materializes or not, is already reverberating through the markets, and we had seen such a surge in the market since the unfortunate events started unfolding themselves. There is no capacity in the world at the moment that can replace 7 million barrels of exports, assuming that we are going to lose a volume of that region. It's not about market share now. It's how do we mitigate? How do we overcome this crisis?
The slide in U.S. stocks accelerated on Monday, with all three main indexes ending the session sharply lower, as the prospect of a ban on oil imports from Russia sent crude prices soaring and fueled concerns about rising inflation. The Dow ended down more than 2.3% in correction territory, having fallen 10% from a recent peak. The S&P 500 finished down nearly 3%, marking its lowest closing level since June of last year, and the tech-heavy Nasdaq closed down 3.6%, confirming it was officially in a bear market, now down 20% from its record-high close in November. It marks the Nasdaq's first bear market since 2020, but Ross Mayfield, an investment strategy analyst at Baird, said that longer-term tech stocks were still a good bet.
If Russia, Ukraine, or the Fed raising interest rates really does curtail U.S. economic growth, to a point where we're looking at an economic slowdown into potentially a recession, I want to be invested in companies that can bring their own growth to the table, like the high-quality technology firms. So I think that's a place that is a bit out of favor, which is crazy to say after the last decade, but is a bit out of favor now that we would be looking to.
Tech giants Amazon, Microsoft, and Apple were among the top individual drags on the S&P 500, while the banking sector fell 3.7%. Shares of United Airlines fell 15% and Norwegian Cruise Line dropped 11.5%, among a broad downswing in travel and leisure stocks as the jump in oil prices threatened to disrupt a nascent recovery. Oil prices continued to surge higher, reaching their highest levels since 2008, as the United States and European allies considered banning Russian oil imports in response to the country's invasion of Ukraine. Shares of the highly shorted meme stock Bed Bath & Beyond skyrocketed as high as almost 78% on Monday, after billionaire investor Ryan Cohen said he now owns nearly 10% of the struggling retailer and wants it to explore strategic alternatives that include a full sale of the company. Cohen, who co-founded online pets products retailer Chewy and is chairman of the board at video game retailer GameStop, another meme stock company, said in a critical letter to the board of Bed Bath & Beyond that the company had a, quote, overly ambitious scattershot strategy and that it's overpaying its top executives. Cohen took aim at CEO Mark Tritton, saying he has failed to navigate supply chain issues and presided over a 14% drop in core sales from a year ago in the most recent quarter. Cohen added that Tritton was paid about $27 million over the past 2 fiscal years, noting it was far more than what CEOs earned at much bigger retailers, including Macy's and Kohl's. Bed Bath & Beyond said it would review Cohen's letter, which also said the retailer might be better off owned by a private equity company. Bed Bath & Beyond was part of the meme stocks phenomenon last year, where retail investors fueled eye-popping rallies in certain stocks, coordinating through online message boards, Reddit, and StockTwits, which cost short sellers billions of dollars. By midday on Monday, shares of Bed Bath & Beyond had given back about half its gains from the market open.
As the world's biggest gathering of energy industry leaders returns to Houston this week, the eyes of conference goers are on Europe. Attendees at the CERAWeek conference have been anxiously watching the events in Ukraine unfold as the economic fallout continues to spread. Global oil prices have reached levels not seen since 2008, while gas prices have also reached record highs, delivering a combined rise in energy costs that is slowing economic growth. Executives are weighing the need for more oil in the short term with the pressure they face to pump less in the long term as the economy transitions away from fossil fuels.
I think it's going to be one of the large topics.
Ronald Thiessen is the president and CEO of Northern Dynasty Minerals. He thinks the conflict will impact the green transition.
Definitely, put a dent into the speed with which that transition happens. And the question is, can we accelerate it? Are there other sources that we can look to if we can't look to Russian oil and gas?
Gary Jauha, a consultant for S&P Global in Asia, said clients are concerned across the globe.
So I think the whole aspect about energy transitions in an era of extreme geopolitical changes is something of huge interest to our clients in Asia, globally, and just the pace of change. That's the theme of the conference, the pace of change, and that's what we are in right now.
Attendees will all be watching for any news that the West is about to ban imports of Russian oil.